So listen up, guys. If there's anyone out there with a mortgage, you got to listen to this, especially those out there that have not been able to pay their mortgage for the past 3 consecutive months. If you've not been able to do that, your lender is most probably starting a foreclosure process on you. You may not know right now. You got to listen to this so you know what to expect at the other hand of foreclosure. Once the process begins, in some states and some areas, you can stop the process. Sometimes making some payments can actually put a stop to the process. But if you can't stop the process, you're going to lose more than financial losses. You stand to lose financially, you stand to lose personally, and there are some losses that I call collateral damages. I'm going to explain all that in this video. Pay attention. My name is Yemi, and this is what I do. I bring information to you before you do deals in real estate. At the end of this video, I'm also going to show you how you can avoid any kind of foreclosure in future. Foreclosure is a nasty business. There is a dark side to it that people don't usually see. All they see is financial losses, and sometimes they're okay with that. But there are some things that follow that you may not be prepared for. So welcome back. Foreclosure sometimes can be out of your hands. There's nothing you can do about it. You lost your job or something big happened and financially you can't just make it anymore. There are some organizations out there that can help you keep your homes. But if you end up letting a foreclosure happen, I'm going to walk you through some of the other effects of foreclosure. Before we move forward in understanding foreclosure, we have to talk about the type of mortgages you get. If you have an insured mortgage or uninsured mortgage. For the insured mortgage, it's because your down payment was smaller than 20%. If that was the kind of mortgage you got, you must have gotten insurance from CMHC if you're in Canada or the FHA in the US. These are the two biggest insurers in the two countries. There's about 3 insurers in each country, and these two are the biggest. What they actually do is insure the banks, not you. You're the one paying for the insurance, but they're actually insuring your mortgage with the bank. So in case of foreclosure, the bank takes your house, sells it in the open market, and if they short their loan to you, they get the balance from CMHC or the FHA. So it's not really covering anything for you. The only thing is it may prevent you from having to declare bankruptcy because nobody may be coming after you to sue you after that. If you got the uninsured mortgage, that means you dropped a 20% down payment. That's 20% of the purchase price. If that's what you got, that's an uninsured mortgage. What happens in that case when you go through a foreclosure? If the bank sells your house and the bank is short, they come after you for the change. Yes, you got to pay them the balance. In that case, most people end up having to declare bankruptcy. So it's like going from frying pan, foreclosure, into the fire, bankruptcy. Either way, if it's just only foreclosure you did, or you had to do foreclosure and bankruptcy, your credit gets ruined. Your credit report, it's like going back down to 0. You can't really get to 0. It starts from 300, but you get the idea. You're going to have to start over. It's as simple as that. And for the next 3 to 7 or plus more years, nobody out there in the financial world will give you any loan. It's like you're going back to becoming a tenant, and baby steps throughout till you can get something back on your credit for people to actually take another look at you. Foreclosure follows you for a long time. Bankruptcy follows you for a long time. But financially speaking, still, you get to lose your down payment and you also get to lose your equity. Depending on how long you've been paying for your home, you get to lose that. All that money that you've paid up, gone. Your down payment, the original down payment, which is between 1 and 20% that you put down, all that is gone as well. That's what foreclosure does. On the personal side, foreclosure also affects your kids because when the house is sold, all you have to do is get out of the house. And that means if your kids are in the middle of a school year, you have to move them from a nice house into maybe an apartment or your relatives' homes. I mean, there's so much stress personally that comes with foreclosure, you know. Also, on the personal side, foreclosure is a financial burden. And as we all know, financial stress is one of the top reasons why people divorce. So you could have a happy family before all this begins, and during the process, or even after the process, a divorce happens. So foreclosure leads to divorce. And then after the divorce, the person that leaves the house may actually end up as a collateral damage if they do not take their name out of the mortgage after divorce. You could be a collateral damage. In fact, not just your spouse, anybody's name that's on the mortgage with you gets their credit wrecked as well. The banks don't understand like, oh, this is just my friend that just co-signed with me, that just helped me out getting the mortgage. No, it affects everybody across the board as long as you're on the mortgage, and usually it's the same set of people that are also on the title. Those are part of the collateral damages that comes with foreclosure. This people, they're not actively in your mortgage with you, but if you miss the payments and gets the foreclosure going and gets the foreclosure done, everybody gets wrecked. Those are collateral damages that comes with foreclosure. Also, some other collateral damages with contractors that do jobs. You know, if you're a contractor out there and you do a job for someone and you say, you know what, I'm going to put a lien on the house. Guess what? After foreclosure, the method of payment is the first mortgagee, as in the first mortgage holder, gets paid first, followed by the second mortgage holder, followed by the third mortgage holder. If the money is all done before it gets to you as a contractor with a lien on the house, you don't get nothing. You're going to have to sue the homeowner, who, by the way, may just end up declaring bankruptcy, and you still get nothing. So those are collateral damages that comes with foreclosures. And the last collateral damage are tenants. There's some tenants out there. You just want to give first and last, you know, but to get the unit, you offer more payments to the landlords voluntarily, you know. Some landlords don't force you to do it. You say, I want to give first 5 and 1 last, and landlord talks you into saying, okay, we'll do first and 5 last. Instead of first 5 and 1 last, you end up doing 1 first and 5 last. If a foreclosure happens in the span of your agreement being over, your tenancy is still going, the new owner of the house may not honor your extra months that you've not used, because legally you're supposed to pay 1 last month. If you have 5 last month, the new owner may only legally be allowed to give you 1 month as your last month. So be careful when you put offers in for rentals and you do extra months. and you push those extra months to the end, anything can happen before your 1 year term is done. So be careful to not become a collateral damage in a foreclosure process. And the way to avoid foreclosure, very simple. As you get your property, as you get your house, make sure that you can afford the mortgage. It doesn't matter if you have a basement and you're going to put a tenant in it. Make sure just you by yourself can cover the mortgage in case your tenant stops paying. The banks are not going to be like, okay, we understand the tenant is not paying, so take your time and pay us back. No, they're going to start the foreclosure process on you and kick both of you out. So make sure you do not get a mortgage that you cannot carry, that you cannot pay by yourself without any help. That's the best way to avoid foreclosure coming in future. And another way to avoid foreclosure is to not spend your house while it's still a liability. Some people buy houses and then they go on a spending spree, shopping spree. They refinance and refinance and refinance their house that is not even paid up yet. When you get a house, all you should be focused on is paying it off. If you pull equity from it, it's to do a solid business. Maybe buy another house, maybe buy land or something. Don't gamble your house away and then end up in a foreclosure. So if you cover those two, at least those are under your control, because some other things happen out there that can actually get people into foreclosure that's out of their control. But that's not what we're talking about today. Those two things that are in your control them, and you won't be facing a future of a possible foreclosure, because there's a dark side to it. And the best thing is not to go into that abyss. Pull back, save your house, save yourself, maybe sell before the foreclosure is even possible. And you can walk away with something, or maybe even with nothing, but at the end of the day, you're not going to be owing anybody. Hope this has helped someone out there. If you appreciate what I'm putting out here to give you information before you do deals, please subscribe. I hope I've earned your subscription. And if you have any comment, or you have a situation where you actually experienced foreclosure, or you know someone that did, drop a comment as well. Let everybody out there learn from your experience or from your stories. And I will see you at the top.